also how to protect those interests with a net-based tax. And so with the PPT, it became clear that the state does not have certain tools, and we break those down into people, information, and clear rules. We'll talk more about that in just a moment. It left loopholes, as the governor indicated, the biggest of which, or the most obvious of which, related to improperly maintained pipelines and the issue of whether or not the state should be giving a credit and providing a portion of the payment for the replacement of these. And the legislature last year was working on this issue and was moving pretty good on getting a solution, but it was something that stalled at the time, but it remains in the law and something that we believe really needs to be fixed. Also, when you have just a pure net tax with nothing else, it leaves the state vulnerable in situations where you'll have low prices or potentially high costs. And in those situations, the state could potentially go on down to a zero or less on the tax revenue. And we believe it doesn't protect the state in those times where you have some periodic dip in the oil prices, and that needs to be addressed. And finally, what we recognize, and this is a result of a number of things, but I think part of it is the relationship between PPT and the previous contract with just the producers, is that the terms related to explorers, we believe, are not of the type that provide equal value between the explorers and the producers, and that even though the state is providing a certain amount of value into the system, that full value isn't going straight to the explorers, where it's directly. We need to address that. So we believe that ACES is needed for Alaska. It protects the state's interests. It restores the public confidence so we can have a stable tax system on into the future. And it also looks at the economics and recognizes that we can increase the share, push those numbers up, while still keeping the investment opportunity positive for the fields that we see coming online. And that's the opportunity that we see to move that up while still retaining that investment plan. And ACES provides that proper balance. So what is ACES? What are the pieces of it? When you get down to it, we've got a hybrid tax combining aspects of a net tax base and a gross tax floor. And it also adds the tools that we need in order to protect the state's interest in that type of a tax environment with sort of a net tax. So under the net tax, there's a lot of discussion about the tax rate. Under PPT, that tax rate is 22.5%. ACES proposes that it be raised to 25%. Progressivity is a function of recognizing that when prices are higher, when profits are higher, that the percent of the tax rate should increase. It's economic recognition that in those times of higher margins, higher profits, that the state can get a bigger share. And PPT includes a progressivity factor. We're adjusting that. We're having it kick in earlier at a $10 lower price, but the slope of the increase is a little bit lower. And we're calculating it on an annual basis as opposed to monthly to try to eliminate the arbitrariness of having just spikes during a particular month, kicking in a progressivity factor that we think is not a fair share between the state and the companies. We also are adjusting those credits. Under both PPT and ACES, we provide 20% credit on top of being able to deduct it from your overall tax base for capital expenditures. Those expenditures going to new facilities, new exploration, new development. The state is providing that additional value. With the PPT, all of that is taken in the first year. When a company comes in, makes that expenditure, they get to get 20% right away. When talking with the consultants that we brought in that have experience around the world with different systems, and just by the way, as a side note, one thing we did learn is that around the world, at the different areas where they have similar prospects and size resources that we have, they're all taxing on a net-based system as well. But in those places, when they have these capital credit programs, they generally spread them out over some period of time rather than giving them all up front, which was seen as a bit unique for Alaska and perhaps unnecessary in comparison to other places around the world. What we recognize is there are some values to looking at least spreading it out over 2 years provide the state with some insight from one year to the next as to what to expect the costs to be deducted that following year, and keep us from having any particular surprises, because we'll always know what half of the deductions, those credits, are going to be the following year. But in addition, if we have situations where the expenditures, those capital expenditures, are going up and down from one year to the next, having it over a 2-year spread smooths that out, so our revenue isn't going up and down with those expenditures, something that we don't have direct control over. As I mentioned, we improve the credit system for explorers. Primarily, we do this by providing cash for the credits. If you think about the current system, what happens is a particular explorer will generate a credit. They'll put money into a new development project. They're a new entrant into the state. They don't have any production. They don't have any tax liability. Since they don't have any tax liability of their own, they don't have anything to reduce or to take that credit against. And so they're sitting there with their credit without anything to take it against. Under the current PPT, they're allowed to sell that to somebody who has that tax liability. And they sell that for whatever they can get. Currently, we're finding that the market isn't as vibrant as we would have expected. But we would expect in the end, even if it works out, we're talking about getting somewhere in the neighborhood of 90, 92 cents on the dollar. And what happens in the end is the state gets the full value of that credit reduced from somebody else's taxes. So we give a credit for $100 to one person, they sell it for 90, the state gets $100 less. So rather than having that middleman sit in there and take the $10, we want the whole value of that full $100 was intended to go to the explorer. We're going to give it to the explorer rather than having it be siphoned off by somebody else. And we're just going to do that rather than taking the $100 less. Give us the full $100, we'll pass it on to the next guy. Finally, we're proposing elimination of the so-called TIE credits. The TIE is a term for transitional investment expenditures. This was intended to provide a credit for past expenditures. This is looking back in the 5 years before PPT was passed, allowing companies to take a credit in the future for having those past expenditures. What we believe is the policy of having a credit program, of trying to incentivize future expenditures, is just that. We're trying to change behavior. We're trying to get them to make an expenditure that perhaps otherwise they wouldn't. And therefore, it should be forward-looking and only providing benefits to those expenditures that they make in the future rather than giving a benefit for a past expenditure. And again, this is what we believe is a recognition of that this is a benefit for existing as opposed to new explorers coming in. And it tips the balance of the value that the state is providing to this program towards the existing players as opposed to spreading it evenly between existing and the new guys. And then finally, within the hybrid system, we've got the gross tax floor. This is to protect the state in those times of low prices. This preserves at a level that we believe can still sustain investment in these legacy fields, a gross tax-based guarantee of some revenue to the state in these low price situations. We have applied it only to the 2 legacy fields, Prudhoe Bay and Kapar, who have economic structures that we believe can withstand this additional tax and make it through those lean years and continue to produce without a negative impact. It kicks in at low prices. It's not additive. It doesn't add additional tax to those legacy fields, except in situations where their net tax gets driven down below what would otherwise be the gross tax equivalent. Next slide. So the second part of the ACES program, beyond those fiscal changes, as I mentioned,